that is actually called a buy right, and there are plenty of traders that will put on a covered call using that method. I think for most traders, there are doing covered calls against existing stocks that they own, and so they're selling that call, and of course keeping in mind that sometimes they don't always want that option to be that stock to be called away, so they're selecting options that fit into what that goal is. Now, always remember, the premium that you sell those calls for, you get to keep, regardless of whether that option is in the money or out of the money come expiration. And one of the added bonuses, if there is a dividend and you don't get assigned on your call, you could potentially collect the dividend for that long stock. Now, what is the environment for putting on one of these trades? For the most part, traders are looking for a stable marketplace. They might be slightly bullish, but they're really looking for something. They're expecting the stock to stay close to where it is. As we all know, you sell an option, you have an obligation. So as a call seller, that obligation is that you have to sell the stock at the strike price that you've selected at the time you selected an option. Now, one thing that you have to be concerned about is early assignment. So on equities and ETFs, we have the American style option, and your option could be, your call option could be assigned anytime before expiration. Now, along with the obligation, you actually do receive that option premium. And as I just mentioned, that option premium is yours, and that is what you receive for the obligation of writing that call. Profit and loss. The first thing I want you to think about when I'm going through these 3 points is the fact that selling that call, that premium is yours. And as we go through these 3 points, keep in mind how that premium you collect impacts these 3 things, starting with the limit. So in the profit end of the spectrum of holding this covered call, the profit is limited. The profit is the difference between where you purchase the stock and the strike price you've selected, and you also get that additional premium that you sold the call for. So that's your profit, and we're going to go through some examples of that. Break even. I can't tell you how important break even is to me. When I look at a position, usually one of the first things that I calculate is that break-even point. Now, if I buy stock, my break-even point is the price that I purchased that stock at. But if I do a covered call, one of the benefits of that premium I collect is it actually reduces that break-even point. So it'll, that break-even point will be lower. And one of the things that you can think of as that new break-even point, you can also think of it as your effective new purchase price. And the reason I mention that is because downside for any kind of covered call and the downside for purchasing any stock could be substantial, right? If the stock goes to zero, that is a substantial loss. But that premium that you sold that call for does give you a limited protection on it. But again, when I look and I think about putting on a covered call, especially when everything works out and I've collected the premium, I've effectively lowered my purchase price for that stock. So we're going to review a particular trade. So A trader is, he owns some stock, and he owns XYZ at $52. And he's trying to figure out how to generate some additional income because the market is not really doing a whole lot. The stock has not moved for a little while, but he doesn't just want to sit on the stock and the cash that he used to buy the stock. So he's going to look at a way to generate income. And when he looks at what strike he wants to sell for this covered call, he's going to use a few factors in it. One factor is how much premium am I collecting? Another factor is what is that price difference between where I purchased and the strike price that I want to use? So where am I willing to sell this stock at if I were assigned on the call? So those are the things that you should be asking yourself when you're putting on a covered call. So in this case, the trader decided that selling the 55 calls that are a month out, because that is his time frame that he's using. So a month out, $1.75. And of course, like I said, the first thing I want to do is, hey, where's my break-even point on this trade? Well, I bought the stock at 52. I collected $1.75 premium. So my break-even point is 50 and a quarter. That gives me a little bit of comfort because if I hadn't sold that call, right, my break-even point is higher and it's at $52. So now I have a little bit of cushion there. My effective price, again, if everything works out in terms of me collecting that premium, I now have a new effective price of 50 and a quarter. And of course, on the downside, I still have the risk that I would have had if I had not sold the call. I just have that additional little buffer of $1.75. On the upside, so when we're looking at the upside, and I'm just going to go straight to your maximum profit that you can make on this trade. So my maximum profit is the difference between the strike price and the purchase price, which in this case is $3. And then I have that additional premium that I sold it for. So my max profit on this, is $4.75. So if I either one get assigned on my option, on my short call, I will make the $4.75, which is my max profit. And even if the stock goes to 60 or 100, that is the most I'm going to make, the $4.75. Now, getting back to my break-even point, as long as the stock is somewhere between that break-even point and my 55 strike, I will have some additional income. In this case, it would be the premium that I sold the option for. So let's look at the graph. So this is a simple graph. You can see that if at 55, you can see we have a flat line there, and that flat line is basically our max profit of $4.75. There are different ways to come to that max profit, so I just wanted to point this out. One, I did a calculation where I look at where I purchased it and my strike price, that difference, and then I add onto it the premium that I sold the option for. But this is another way to look at it. So you can look at your strike price of 55, add your premium. So effectively, you're selling the stock at 56.75, and you bought the stock at 52. So you have a profit of 4.75. So that's just another way to look at it. Like I said, there's all different ways to look at how you derive that profit, and that's just two of those. Break-even point, again, we're looking at 50 and a quarter. Anything below that, you're going to lose the same way you would lose on stock. The new effective price, if it does not get to the strike, is that 50 and a quarter is your new effective price. So this time I thought that it might be worth looking at a forecast that's a little bit further out. So in this case, we're looking at 2 months out. Our forecast has not changed that much. We're still moderately bullish to neutral. We're expecting the stock to stay within a range. And because I've given myself a little more time, I'm also giving myself a little more room for the strike that I'm using. So instead of selling the strike closer to where I bought the stock, I'm going to go out a little bit further, in this case, $65. So I've got a $6 room there. And because I'm selling an option that is further out date, I do collect a little bit more premium. So in this case, I'm targeting a wider time frame, but I'm also giving myself a little bit more room for selling my stock if I have to potentially sell it, and I'm giving myself a little bit more premium there. So if we're looking at this table on the right here, you can see the maximum profit here is $8.25. Now, of course, that's the difference between where I purchased the stock, the strike price I used, which was the 65. So that's a $6 difference there. And then, of course, the premium that I collected, which is $2.25. So so that potential profit is $8.25. Now, if I did nothing at all and I just owned the stock, my profit would be $600. So adding that extra layer of that covered call has given me more profit than I would have expected if I just owned the stock. On the downside, right, so our break-even point in this case is $56.75. So $56.75. That is our break-even point. That is also our effective price if the option expires out of the money. The 65 call expired out of the money. Now, on the downside, we're going to look at this two ways. One, if I did not do the covered call at all, right, and the stock went to 40, I have a loss of $1,900 for my 100 shares. So with the stock down $19, I would have a loss of $1,900. Now, because I did the call, once again, that premium has offset that loss. So instead of a $1,900 loss, I have $1,675 loss. So there are benefits of selling that call, and one of them is just that, again, that cushion for the premium that you sold the call for. And here's our graph. So you can see we have that flat line where we hit our maximum profit of $825. That is the 825 times the 100 shares that go along with owning the option. Our break-even point is $56.25. And the new effective price that we purchased this for, if our call goes out of the money, is $56.25. So anything below $56.25 is when we'll start to see a loss. Oh, all right. So I would be amiss if I didn't talk about early assignments on these calls and ways to kind of prevent that for those of you that are, have an emotional tie to your stock, which a lot of traders do. So if you are concerned about assignment and your options are in the money, there's a couple of things that you can do. And one is just simply buy the option back in. But probably something that's a little bit smarter to do may be rolling your option out to either a higher strike or to an option that's dated further out. So there's always ways to prevent from being assigned. Now, one of the things you have to take into consideration is when a dividend is going to be paid. And if you have an option that, if your short option is in the money, there's probably a pretty good chance that you will be assigned on it because the person that's holding that call is going to want to have that dividend. So if you want to prevent that to happen, again, you should think about either rolling to a higher strike or rolling out to a further dated strike. So this brings us to LEAPS, which is such an interesting product. And for those of you that don't know what the acronym LEAPS stands for, it is long-term equity anticipation securities. And currently, if you were to look at an option chain, you could see that LEAPS are, currently we have the January 2023 LEAPS. We also have the January 2024 LEAPS. Those January 2025 LEAPS, those will be listed in September. So if you're ever wondering when the next LEAPS are going to be listed, it's usually in September, but of course you can go on our website to see when those are going to be listed. Further, options, these LEAP options start to be considered normal options about 9 months before they expire. So that's just some good info to know. The benefits of owning a LEAP, especially when you're taking the consideration of owning stock. Well, one is, that it takes less capital to buy an option than it does these LEAP options than buying stock. Another is leverage. So when I talk about leverage, we're talking about buying a call and what the cash that's left in your account and what you could do with that cash. So you have some leverage, you've left some cash in there, but that leverage also gives you an opportunity to actually, if you have a positive, profitable trade, you're going to have a greater percentage trade there. So that leverage, you leave the cash in your account, you have leverage with the option you buy, that leverage gives you an opportunity to even earn interest on your account. Now, when you're placing a trade, if you're looking at what option you want to buy, especially if you want to use that LEAP as a substitute for stock, you might be looking at an in-the-money LEAP, and it's important to kind of understand what that delta is, right? So you might want a higher delta for that option. A higher delta gives you a better correlation with what's going on with the stock. So if you buy a LEAP with an 80 delta, right? So every dollar move that the stock makes, you'll see an increase of 80 cents for your LEAP that you own. So that's an important piece, and that's certainly a very important piece when we start to look at this poor-man covered call. This brings me to pricing of LEAPS. And actually, I'm always excited to talk about this. I traded on the floor when LEAPS were introduced. And as a market maker, like every market maker on the floor, we had only been pricing options that go out 9 months. So when the exchange decided that they were going to, introduce LEAPS, and we were going to have to learn how to price these options that are 2 years, more than double what we've been pricing. Not only was there anxiety that went along with that, but there was a lot of discovery that needed to be made. And so for me, that meant taking my model and testing these LEAP prices. And some of the stuff that I discovered was what I expected, and some of it was I was really surprised about. And so I'm just going to highlight 2 of those. And one is the time to expiration, and the other one is volatility. Now, time for expiration, right? I did expect the value of my options to be much higher, right? I expected intrinsic value for an option that's going to expire 2 years out to be more expensive. But along those lines, I thought to myself, well, maybe selling a LEAP makes sense, right? Because of theta. If when you buy an option, you have negative theta, right? So buying an option, that option expires a little bit, that option decays a little bit each day. That is what theta tells me. Positive theta is when I'm short an option, and every day it decays. I keep that decay, right? So they're getting cheaper, and I'm happy because I had sold the option, and the option's getting cheaper. So theta tells me how much that option is going to decay daily. So here I am thinking, made some assumptions that maybe I would want to sell these LEAPs until I discovered this. And I started looking at that theta number. And if you notice, right smack in the middle of this table where I say theta, 365 days out, that decay is 0.05. Even 150 days out, right? The decay is 0.08. When I look at theta, a month out, 20 days out, 10 days out, 5 days out, that's where you see the impact. So I had to really reverse thinking, like, I don't think I want to sell these options. And that being said, I do know there are plenty of people that sell LEAPs, but for me, this was my conclusion. I'm looking at the decay of this, and you can see from this graph, the decay is pretty flat up until you get to, closer to expiration. So that's what I was looking at. So in my thinking, I'm incorporating this idea of theta and that impact that it has on this on my long LEAP. So my second discovery was, as we know, implied volatility, right? It affects extrinsic value. But what I didn't realize is how significant one point change in volatility would change these prices. And as I was measuring LEAPs, right, and I'm looking at implied volatility, and the way I was kind of viewing them is I was making a comparison between these LEAPs that were going to expire 2 years from now and my options that I had been trading that expire in 9 months. And realized that, Vega, which is for every point change in implied volatility, that Vega number is how it's going to impact the value of your options. So when I was looking at that, I realized as time goes on, of course, Vega does decrease. So these were a few of the discoveries as I went through the process of beginning to price our options. I'll tell you a little funny thing, kind of funny, but not really funny. But at the time, options our quote system, we could enter all of the, all of the parameters into our system, which would actually send out the quotes. And one of the traders had actually put in the wrong number for interest rates, which is another thing that can have a significant difference. But he put in the wrong number for interest rates. So, but before we even had a chance to see whether or not what those inputs were, we had buyers coming from everywhere, and of course we immediately realized that somebody had made a mistake. We went into the system and corrected them, but because we're market makers, we were obligated to sell the options, which were immediately a loss. But anyways, I just wanted to give you a little background on my experience when LEAPS first came out. So LEAPS as stock replacement, I guess the beauty of buying a LEAP versus stock is, of course, the capital outlay. So it is an efficient use of your capital to buy a LEAP. So the other factor that you kind of have to measure is deciding which LEAP you're going to buy. And as I mentioned before, buying an 80 delta LEAP is a good kind of starting point if that's what you're looking at. Now, of course, there might not be an 80 delta LEAP out there. There might be a little bit less. And if those are a little bit less, then you've always taken into consideration if the stock moves dollar, how much is my LEAP going to profit from? So anyways, the stock replacement is a fantastic trade if you don't want to use all the capital you have in a larger amount of capital in your portfolio. Now, potential risk. Now, of course, LEAPs and all options have a limited life for them. So if you are thinking that this is the equivalent of buying stock, it's just not. Stock is a long-term investment, and LEAPs or options are a short-term investment relative to maybe your owning the stock. I want to point out whenever you have a option position, whatever it is, LEAPs included, there's a certain amount of managing that goes on with that. So where you might just have stock, there's a little less that you have to manage versus looking at your LEAP position. There are a couple of downsides to owning a LEAP. One of them is the bid-ask width. So for those of you that don't know what a bid-ask width, when you go to buy an option, you are potentially buying it on the offer, which is going to be higher than where the market makers out there want to buy it, want to buy the option. So the width between where you can buy it and where you can sell it can be significant, that width. Now, we use the terminology slippage, and the way you can look at slippage is what are you going to pay to get into the position and out of the position. And that difference, that width, the difference between the bid and the offer is kind of the cost that you may pay getting in and out of an option position. The other one, of course, option holders do not receive dividends, only stockholders do. So if you are using this poor man covered call, keep in mind, you will not receive the dividends for that LEAP position. So, poor man covered call. So what exactly is a poor man covered call? Well, it's a cost-effective alternative to doing the covered call, right? You're substituting stock with that leap. That leap is going to take less capital, and this whole position, right, isn't going to use the kind of capital that you would if you had a covered call. So the capital that's left in your account you can use for something else. But this poor man covered call, you've bought this long-term option. You'll expect to sell a call against that. There are some risks with assignment, and we'll talk about that. But the expectation is you sell that call, and hopefully it expires, and you do it again, and hopefully it expires, and in the meantime, you're holding this long-term leap. Now, typically, traders buy an in-the-money leap, and the options that they sell, near-term options, are typically out-of-the-money calls. So let's do a side-by-side comparison between the traditional covered call and the leap covered call. A couple of things that, for the most part, you're putting these trades on for the same reason, right? You are neutral to bullish. You actually, the upside profit is limited for both of them. Your downside risk is substantial for, the covered call, less substantial for the leap that you purchase. The upfront, so then we have our upfront capital, which is substantially less for the poor man covered call. What I really want to get to is that assignment risk. And this is really, this is the one risk that you need to take into consideration if your short call ends up being in the money. And that risk for just the traditional covered call is that you sell your stock that you're long, right? But for someone that is long a leap, that means something completely different. And that means that you could potentially, for one day, be short the stock against your leap position. Now, this is something that you probably should ask your broker how that would work, even if you could do that. And if you can't, of course, one of the things you want to prevent that, and one of those prevention is either buying in that short call so that you don't have the risk, or again, rolling it to a higher strike call or rolling it to a further out option. So that assignment risk is real when you have your short call is in the money. The break-even point, two different calculations here. We can look at that. You guys can look at that later. But I want to get to this Vega exposure. So I, briefly talked about my experience of my analysis of leaps, right? And one of those was Vega. And so in that Vega exposure, you don't have Vega if you're trading stock, right? Stocks don't have Vega. There is no volatility exposure, implied volatility exposure, where with leaps, you have that exposure, right? So when you're looking at your leap, and I always used to test my options, and one of the tests that I would do is to see what that Vega exposure would look like. So I might put in an implied volatility that was a little bit higher, so I could actually see how much I would make or lose on an option depending on if implied volatility went down or if it went up. So anyways, you have that Vega exposure with stock that you do that with options that you don't have with stock. So this is just common practice. Some people use this as a point of I'm at a loss for the word I'm looking for. But anyway, so these are common practices, not set in stone, but many of the traders are looking at buying an in the money LEAP that has an 80 delta, right? That would correlate as closely as possible to that underlying stock. It's not always easy to find that LEAP that has that 80 delta. I mean, it has to be pretty far in the money for you to find that. So you're going to have to adjust your parameters based off of whatever LEAP you find and whatever that delta is. Again, typically when they're selling a call, they'll be looking at a 30 delta option. I'm just going to add just a little side note about delta. And this is one of the ways that I look at delta. So anytime I'm looking at an at the money option, that option usually the call has a 50 delta and the put is a 50 delta, right? So beyond that, when my call goes in the money, that delta increases while my put delta decreases. And the reverse is true also, right? As the call, as the put goes further in the money, right? That delta increases and my call delta decreases. So we have this correlation here. So if I'm looking at, what I'm going to purchase, I always kind of look at that at the money call as that 50 delta, whether it's a put or a call, and that 50 delta from there, I know any option, any call option that has a lower strike is going to have a higher delta, and any call option that has higher strike is going to have a lower delta. And that's just one way that I look at delta and determining what the delta is, starting with that at the money option. Now, we're going to put on a trade here. Again, we're going to be comparing, putting the covered call on. So the stock is trading $82. At $82, our LEAP that expires January 2024 is offered at $14.25. So if I'm going to do a poor man covered call, I'm going to be looking at buying that call for $14. And for both of those strategies, the covered call and the poor man covered call, I'm going to look at selling that 30 delta option with the strike price 85 for $2. So what do we have here? We have an investment. If I buy stock, my investment is going to be $8,200. So I'm buying 100 shares at $82. Or I can select to buy one option that's worth 100 shares for $14.25. So I'm comparing these two investments, and I could, invest $8,200 of my capital, or I can invest the $14.25. Now, for those of you that already own stock, right? This is not a decision that you're going to be making. But for those of you that want to put on a poor man covered call because you don't want to own the stock, this is the analysis that you'd be looking at. And of course, in both cases, we are going to be selling that out of the money call option. It's a 30 delta for $2. So, what is our risk here? And again, I talked about break even and how I always calculate break even, trying to figure out when my downside risk starts. In this case, you buy the stock at $82. it's offset by the premium that I collected from selling those 85 calls for $2. So my cash outlay for this is $8,000. One, my downside risk is potentially $8,000. You, as an investor, if you don't have some kind of margin account, you will have to put up the $8,000 for that trade. Now, for the poor man covered call, each option is worth 100 shares. So I'm buying one LEAP. I'm paying $14.25 for that LEAP. The one thing I'm going to point out here is that LEAP, right, is $12 in the money. So the stock, the LEAP is 70, the stock's trading 82. That LEAP is $12 in the money. The extrinsic value of my LEAP is $2.25. That's an important piece of this, especially when I'm trying to get to that 80 delta option. If I was trading a 90 delta option, of course that premium, that extrinsic value would be less, because that for me to get to a 90 delta option, I have to buy an option that's further in the money. Now, stepping back, we are still selling the May calls, the 85 calls, and collecting our $2 for that. So my investment in the poor man covered call, right, the $4.25 minus the $2 is $12.25 times the 100 shares that the call is worth, is $1,225. That's my investment between the two. So I wanted to take the time to look at what that impact is, both actual dollars and percentages. So for, hold on a second, there we go. For XYZ, the stock, if it goes down to $75, XYZ stock, we're going to lose $7. And that's 8% of the value. You add into that your short call, right, that you sold at $2, your net loss is going to be $5. So, and that's 6% of your investment. So this, for those of you that like to look at your profit using percentages or annualized percentages, this is one way to look at it. For those of you that just want to look at hard dollars, right? If the stock goes to $75, you're going to lose $5 on that trade. Now, for our long call position, if the stock goes to 75, you can see that the value of those calls now are $8.65. So we've lost $5.60, which is 39% of our investment, right? Which makes sense because we basically put up less capital, and so our loss, our percentage loss is greater because we put up less capital. Now we've still got the offset of selling our those 85 calls. So again, excuse me, the for the poor man covered call, the loss in just dollars, it's $3.60. In percentage terms, it's a 29% loss. Again, our investment was lower than if we had just done the covered call. So let's look at this trade on the upside. So if the stock goes to 90, and now our 85 calls are in the money, on our stock position, we've made $8 on that trade, right? So we're up $8. Stock's trading 90 now. Getting down to our short call position, that call is $5 in the money. we sold it for $2, so that's a $3 loss. So we've made $8 on the stock position, but we did lose $3 on the option position. But overall, we've made a net gain of $5, which is 6% of our investment. For the long call, we have a $6.40 increase. So it went from $4.25 to $20.65. So we have a $6 increase there. And of course, our in-the-money options, we lost $3 on them there. So our net profit for the poor man covered call is $34. It's $3.40. But percentage-wise, we have a larger gain because we had less investment to begin with. So we have a 27% increase there. So okay, just give me 1 minute. So I thought I would add a little bit of misconceptions, misinformation for trading options. And one of those is that higher premium is a positive. And what goes along with a higher premium a lot of times is more risk. So to use an insurance example, you have two teenagers, one's a boy and one's a girl. They turn 16, you go out to get insurance, and the one that has higher risk, which historically are boys, you're going to pay more insurance for that. So that premium is going to be higher than you are for the girl. So if you want to correlate that to option premium, higher premium could potentially mean that there's higher risk because the expectation is that we might see some kind of larger movement in this underlying. So that's one misconception. Being assigned is bad. Not always, especially when you're holding a covered call, because that assignment is actually just giving you the max profit on your options. Again, there's always that risk that we have with the poor man covered call if we're assigned on that call where we could potentially be short stock against a long LEAP option. But again, the reason I put this in there is because if you have a covered call and being assigned on your options, it just means that you have created the maximum amount of money you can make on that trade. A covered call forces you to sell winners and keep losers. That's not exactly true. It does force you, if you are assigned on your option, to take the max amount of profit. As far as keeping losers, again, you do have that offset from that premium that you sold it for, which is limited. It's not a lot. But you can actually sell the stock if it's a loser the same way you could sell the stock if you're, if you own the stock and it was a loser. This does not put you in the category of keeping losers and selling winners. You always have to manage your option account, and by managing that, this whole sell winners, keep losers, it's not a truthful statement. So lastly, before we end this, I just want to compare a poor man covered call. I want to end this with comparing a poor man covered call to a covered call. And this is really my takeaway. This is what I want you to walk away with. So, of course, a poor man covered call, less capital. So you are going to put on this particular strategy, and you're going to use less capital than you would with the covered call. Higher return on the investment, right? You have less capital in place, and when you have a return, when you get a positive return, percentage-wise, that's going to be greater. Less margin. So when you look at margin, right, if you buy an option, your margin is what you pay for that option. And when you buy stock, you have to put up the money to buy that stock unless you have some other arrangement. But for the most part, you can look at when you're purchasing stock, that margin is the total price of that stock. So when we're looking at these margin requirements for the poor man covered calls, of course, your margin is going to be significantly less than if you were doing just a plain covered call. Less capital at risk. Absolutely, right? You are the risk that you have is what you paid for that leap. Whatever you paid, like all calls, right? Your risk is what you paid for that call option. Same here. And again, the risk is less than what you are taking when you buy stock outright. A couple of drawbacks, believe it or not, it's very difficult to figure out max profit and break even on these poor man covered calls. They're a little bit a moving target there. Whereas when you have a covered call on, you know exactly where you purchased the stock, you know exactly what strike you're using, and all that. But figuring out what that max profit is going to look like is a little harder when you have an option that has all kinds of factors that will affect the price of that option in it. A very big drawback, of course, is that options don't pay dividends. So if you want that dividend, you're going to certainly have to be long stock for that. Another point, very few stocks actually have leaps on it. So when you're looking at wanting to do a covered call, there's a good chance that the stock that you're trading does not have a leap on it attached to it. And as I mentioned before, the wide bid-ask spreads are indicative of leaps. So those are my takeaways. We are actually coming to the end of our time, so we're not going to really have time for questions and answers. I'm sure that Ken and Mark have gotten to most of them. And again, for those of you that we did not answer your question, we will follow up with an email in that answer. I want to thank you again for coming to this presentation. As many of you might have guessed, this is the first time I've presented for OIC, and very happy to do. I've presented. This is our information that we have if you want to contact us. So, of course, we have our website, optionseducation.org. If you want to send us an email, it's options@theocc.com. We have our YouTube channel, Facebook, all those kinds of things. And, of course, on Twitter, just @optionsedu, lowercase, whatever, and edu. So anyways, guys, thank you very much. And this is the end of our presentation.